The title of the paper is Three Sisters, which is about three crises. We'll look at the relationship between sovereign debt, currency, and banking crisis, and our focus is on the emerging market economies. So first of all, a brief introduction about the triple crisis. What do we mean by triple crisis? In this paper is the occurrence of three crises within a year. So given a very short period of time, in some countries like Mexico in 1994, in Asian countries, specifically in Indonesia and South Korea, in 1997, 1998, in Russia in 1998, and in Argentina, we have experienced these kinds of crises, which are, of course, very costly for the economies of these countries. So what we experience here is the sequence of events are all different in these different countries. So, for example, in Mexico, we have the triple crisis occurring in the same month. For example, in Russia, we have the banking crisis and debt crisis occurring at the same time, followed by a currency crisis. In Argentina, first the banking crisis, then a debt crisis, and then a currency crisis. So we are focusing on the relationship and the time period between these three crises in this paper. And we are going to be focusing on sovereign debt crisis and see the interlinkage between currency and sovereign debt crisis and banking and debt crisis. First, I'm going to talk briefly about the previous literature, what has been done before, and what is lacking in the previous literature that motivated us to do this study. And then I'm going to focus on our empirical study. And first we estimate the sovereign debt crisis, and then we estimate banking and currency crisis, and lastly we do a simultaneous estimation of debt, currency, and banking crisis equations, all jointly. The link between currency and debt crisis, theoretically, causality can run both ways. So initial currency crisis can spread into government through the original sin argument. And the original sin argument, of course, based mainly an emerging market economy problem that you cannot simply borrow with domestic currency from other countries, so you have to borrow foreign currency, which leads to currency mismatch in the government balance sheet. And of course, with a currency crisis, it can be lead to a default in the government foreign obligations, of course. Debt crisis leading to currency crisis is also theoretically possible, meaning that a sovereign debt crisis is going to increase the observed riskiness of the foreign creditors about the country, which might lead to a sudden shift of the capital from one country to the other, and can end up with currency crisis. Now, these theoretical links, however, empirically is not established, so empirical papers cannot find a symmetric relationship between currency and debt crisis. What we found, what we see, observe, Reinhardt and Bordo-Meissner find that currency crisis, initial currency crisis might lead to debt crisis, but not vice versa. Herz and Tong, on the other hand, only established a contemporaneous correlation that two crises occurring in the same year. For banking crisis, again, theoretically, the causality can run again both ways. Banking crisis, an initial banking crisis, can lead to debt crisis through bailing out of the government, which the foreign obligations of the banking system becomes a problem of the government, of course. Debt crisis might lead to banking crisis in developed financial systems, where you see that the financial system owns the obligation of the government. This is mainly a problem of the developed countries rather than emerging countries. Empirically, we see that banking crisis, Reinhard Rogoff established an initial banking crisis leading to debt crisis, not vice versa. And there's also contemporaneous correlation. Generally, I cannot pronounce their names, my apologies to them, establish the symmetric causality, but they didn't establish a contemporaneous correlation. But for the debt crisis leading to banking crisis is only established for the countries that the financial system is exposed to government debt. So not all the countries in their sample. And this was the literature so far about the links between banking, debt, and currency crisis. So what motivated us to do this study? Two main gaps in the literature that we found. Most of the studies focus on the dual relationship, either between currency and debt or between debt and banking crisis. So so far there hasn't been so much work done on the triple crisis occurring in different countries. And so we try to establish direct and indirect links between these three crises. And lastly, secondly, the simultaneity of banking currency and debt crisis is not researched empirically, and that's what we are trying to do in this paper as well. The second gap in the literature was all the studies relying on yearly data, yearly occurrence of debt, currency, and banking crisis. So then, of course, we do not see the precision if we have two crises occurring in the same year but in different months, then which crisis initially started and triggered the other crisis. We are also curious about that. That's why we try to use monthly data and try to see the links between crises that are occurring in the same year but in the different months. The empirical analysis of our paper is the period running from 1985 until 2007, only for emerging market economies, of course, because these are the countries that have experienced mainly this triple crisis. We use monthly data, which of course lead us to limit our country sample with 21 emerging economies, mainly because of the crisis identification methodologies and because of the data availability for a lot of countries. What kind of crisis identification we use? For debt crisis, we rely on Arter and Hale's start of the renegotiation of the sovereign debt before any restructuring agreement. So we do not take the restructuring agreement as the default because the restructuring agreement is an agreement that is settled about the new debt payment. So we take the renegotiation, the start of the renegotiations as the default in our sample. For currency crisis identification, we rely on CRAE, which has been also used in our previous paper. And the starting month is the large depreciation, a 10% depreciation in the domestic currency following stable exchange rates. So this limits our data, of course, to stable exchange rates that in the end up with a depreciation in currency. We later on relax this assumption and include volatile exchange rates prior to crisis as well. For banking crisis identification, we used Leuven and Valencia. For their extensive systemic banking crisis database, they have a small country sample which they indicate the starting months of the banking crisis, and we take their starting months as our banking crisis dates in our paper. So in the end, we have 25 currency, 25 banking, and 46 debt default dates in our sample. This, of course, led us to have this table, which we have established debt, banking, and currency crisis dates. What we observe here is mostly currency crisis After a currency crisis, the occurrence of debt crisis takes few months. After a banking crisis, the debt crisis either occurs in the same month with the banking crisis or after 12 months. So the time lag between banking and debt crisis is larger than the time lag between debt and currency crisis. First of all, the indicators that we use various macroeconomic and debt indicators, and we took them from World Bank, World Development Indicators, and from IMF, IFS. And for the inability of country to pay, we use the solvency indicator, public debt to GDP, and the international liquidity indicator, short-term debt, external debt to foreign exchange reserves. For the unwillingness to pay for the country, we use some political indices and the economic and financial riskiness that is taken from the International Country Risk Guide. And these indices, of course, are a lot, and it might lead to some multicollinearity. That's why we used factor analysis and condensed these institutional indices into political and market environment, showing the political riskiness and market riskiness of the countries. To minimize the simultaneity concerns, we lag all the indicators at least 1 month. We use general to specific approach to determine the appropriate lag structure. And this is the equation that we use for the sovereign debt crisis. We use a binary choice model taking value 1, the dependent variable taking value 1 at the onset of the sovereign debt crisis, only at the onset. The continuation of the crisis is taken out from the data and until the end of the crisis. We include the contemporaneous currency and banking crisis, and we also use the lagged 12-month lagged composite lagged banking crisis and currency crisis onset as well. We also are interested in the interaction terms, especially banking crisis. The occurrence of the banking crisis might lead to a sovereign debt crisis if there is high foreign external debt, which becomes the obligation of the government due to the government bailouts of the banking system. And a lagged currency crisis is interacted with exchange rate overvaluation to show us the currency mismatch if it plays a role in transmitting currency crisis into debt crisis. So first, the estimations that are done with the sovereign debt crisis being the dependent variable. We use different specifications. We try not to include the contemporaneous crisis, currency and banking crisis with the lagged currency and banking crisis in the same equation to minimize the endogeneity. Of course, there is endogeneity here because these are contemporaneous currency and debt crisis, which we take into account later on. We see that they are all the contemporaneous currency and bank crisis contributes positively on the sovereign debt crisis probability. The lagged currency crisis is not significant, but the lagged banking crisis is significant and positively contributing to the probability of sovereign debt crisis in our sample as well. The last column shows us the interaction terms. The interaction terms are with the expected signs, and they are significant as well, which shows us this macroeconomic variables also play a role in during currency or banking crisis in increasing sovereign debt crisis probability. Some sensitivity analysis, which are really nice, and robustness checks, but I'm not going to be able to talk. We use a different currency crisis definition, and what I want to say is that including floating exchange rate before currency crisis decreases the significance of currency crisis in explaining sovereign debt crisis, which means that fixed exchange rate is much more problematic in leading to sovereign debt crisis. Estimated currency and banking crisis using debt crisis as indicators, and we couldn't establish any relationship between lagged debt crisis and currency and banking crisis. Then lastly, we use a multivariate approach to estimate all three crisis equations jointly, and then we estimated, of course, the correlation coefficients for the error terms of the three equations. And what we established here, sorry that I have to be quick here, that the correlation coefficient between the error terms of the first column and the second column, which is like debt, sovereign default, and banking crisis, is significant. That shows us that banking crisis and sovereign default are jointly determined, led by common unobservables. But we couldn't establish any relationship between the error terms of currency and debt crisis, and we couldn't establish also the simultaneity of the three crises occurring in the same month, led by common unobservables as well. So the conclusions are that we have strong leading and contemporaneous effect of banking crisis on sovereign defaults, and we established the indirect links between currency and debt and banking and debt crisis. So what we see here is that banking system problems go hand in hand with sovereign default, and what we see is that as long as the financial system is sound, the government can postpone the default decision, and it becomes problematic when financial system is having a lot of government debt and having a lot of problems. Then these two crises can occur jointly in the same month.
I think that this paper focuses on a very important issue that has been brought into focus much more since the global financial crisis. Now, since the European debt crisis has renewed interest in understanding the interlinkages between banking problems and sovereign debt problems, and recently with the problems in China, there is also speculation that that might be the next triple crisis. Bank of America warned in January 2015 that deflation, devaluation, and default could loom in China this year. So a very timely paper on a very important issue, and I agree with you that the literature has not really looked at triple crisis. So, but I do want to note one exception, which is the Gurnain and Pasricha paper 2011, which is very closely related to your work, so I do suggest that you take a look at it. Now, the main results of this paper are that the banking crisis usually precedes sovereign debt crisis, and there is no strong relationship between currency and debt crisis, and the role of worsening fundamentals is as one would expect. Now, this paper also makes a start to exploring the transmission channels between the different types of crises. So basically what you find is that banking crises are more likely to transmit to a future sovereign default if the short-term foreign indebtedness is high, and that currency crises are more likely to lead to future sovereign defaults if the more overvalued the exchange rate was prior to the crisis. Now, from a policy perspective, why do we want to understand the triple crisis or twin crisis or financial crisis at all? The reason we want to understand them is because we want to be able to take mitigating actions sufficiently in advance to forestall a future crisis. So what a good early warning system really needs is early enough warning. I mean, if you think of the Basel counter-cyclical capital buffer, the way it's implemented is you take a decision. Norway has done it to activate the CCB. You take a decision today, and you give the banks a year to build up that buffer, because you actually want the banks to raise equity. You don't want them to raise their capital buffer by selling off assets. So, there's a lag to implementation of policy, and there is a further lag to effectiveness of that policy. So you do want to be able to predict crisis sufficiently in advance that you can take, corrective action to mitigate the risk. But what you do in this paper is focus on predicting timing rather than the incidence of crisis. And so the selective, the general to specific approach of choosing the number of lags, I find that this is actually kind of unique in the literature, because most of the literature focuses on predicting crisis 1 to 3 years in advance. So what you get with that approach is that many of the fundamentals actually predict sovereign defaults 1 month in advance. And by the time the ship has already sailed, there's nothing much you can do to prevent a crash. So my suggestion would be to redefine your dependent variable. You're looking not at crisis and time t, but crisis. So all the future, the independent variables are at time t, but the dependent variable is really if there is a crisis at any time between period t and t plus k. So that's the approach that most of the early warning papers that I know of take, and I suggest that you modify to be closer to the literature. Now, it's the same kind of similar issue with the multivariate approach, where you look at triple crisis in the same month. Now, I agree with you that you do need to take simultaneity into account, that there may be unobservables that determine which crises become triple crisis and which ones don't. But the way it's done in the current specification, I have some concerns about that. One is that the dating may be subject to measurement error. I mean, if you think about the Greece crisis, reasonable people can debate when the crisis really started. Did it start in October 2009 when Greece first revealed that it had been cooking its books for years? And then later in 2009, all the top 3 rating agencies downgraded Greece's debt. And then it was next spring when Greece actually asked for a European bailout. But the Greek default didn't actually happen to the IMF until this year. So reasonable people can debate when the Greece crisis started. So you don't want to constrain yourself by focusing on crisis in the same month when you're trying to explain triple crisis or even dual ones. And the other issue with that specification is that crisis often transmits from banks or capital flow reversals to sovereigns with a lag. And from a policy perspective, it's the channels of transmission that are really, really important. And you do see the issue with using only simultaneous crises in the same month in your data too. So you have 6 debt and banking crises in the same month, but an additional 7 debt crises within a year of banking crisis. So you do recognize this in the first half of the paper, but not when you're doing the simultaneous estimations. So what I want to do is to encourage you, both of these comments are leading up to this main comment that I have, which is to encourage you to push your paper to address the 2 main policy questions, in my opinion, on these crises. The first one would be, what makes triple crisis different? And there has been some literature recently that addresses this question. For example, Gurnain and Pasricha, 2014, they found that credit booms are actually larger ahead of triple crisis. So you want to do something similar with, larger ahead of twin episodes. They only look at sovereign and banking problems, not a triple crisis. So you do want to ask, what is it that makes triple crisis or double crisis different than single crisis? Or what are the main factors? And then Krishnamurthy and Muir, now they only look at financial crisis, but the questions they ask are a little bit different, but I think the results are relevant also to the paper, your paper. What they find is that larger increase in credit spreads at the start of the crisis actually do predict a worse crisis. So from a policy perspective, you really want to understand what is it that makes dual or triple crisis different. And the second important policy question, in my opinion, is what are the transmission channels? Now, policy here is also important. When a crisis starts, how the policy reacts can also influence what happens later. And recent literature has also highlighted the role of policy reaction. For example, again from Gurnain and Pasricha, they find that lower liquidity support from central bank ahead of twin crisis, the central bank support to financial sector is actually lower than during banking crisis that don't transform into sovereign default. So the way policy reacts once a crisis starts is also very important, and that can help understand which crises become dual or triple crisis and which ones don't. And then another lesson from the literature is that ahead of twin crisis, banks are actually more exposed to the sovereign than ahead of banking crisis that don't become also sovereign defaults. My final two comments. One is that maybe you could reflect better more recent work since 2011, which has highlighted the importance of credit gaps. Now, with respect to crisis, a lot of work has been done since 2008, and a very important lesson from that body of work is that credit matters. And it's not about just credit growth, it's about the gap. So all of this Basel agreement and the CCB agreements is relying on the work that shows that how high the booms in credit matter, and you need to measure the gap between the actual level of credit and some fundamental, not just the growth of credit. And an important example is Canada. I mean, if you look at Canadian data, the growth rate of credit has not been that large. What's really happened is that there has been sustained moderate growth for so long that a very large credit gap has developed. So you need to look beyond just growth rates. And then another very influential body of work since the crisis has been by Karataş, Schuleric, and Taylor that really focuses attention on leverage bubbles, on the interaction between credit growth and property price bubbles. And it would be useful to have a more thorough investigation of these in your paper as well. And then another small point, maybe this is just a clarification, is why do you have only 20, the paper I had was 20 countries, but or 21 countries in sample, because if you look at the Arteta and Hale paper, their data has actually 39 EMEs where I could find the banking crisis month, so I'm not sure what is it that's really constraining the data. But probably this is just a clarificatory question. So, well, thank you very much. That's all from my side, and I hope to see future versions of this paper.